Hello, and welcome to Emerging Viewpoints. I'm Nick Stadtmiller. Today, we're joined by Teal Emery to discuss applying ESG investing to the emerging market sovereign debt space and what ESG principles really mean and what they do. Teal is the founder of Teal Insights, a research consultancy that uses modern data science tools to uncover actionable insights relevant to policymaking, financial markets, and business. Teal previously worked as an emerging markets sovereign research analyst at Morgan Stanley Investment Management for 7 years, where he created the firm's first sovereign ESG framework. Subsequently, he worked as a consultant to the World Bank, helping to drive their analysis and thought leadership related to aligning sovereign debt investing with sustainability goals. Teal, welcome.
Thank you, Nick.
So, environmental, social, and governance, or ESG investing, has been around for about 2 decades and was originally designed to apply to investing in corporate debt and equity. And it was later applied into the sovereign debt landscape. And obviously, there's a big difference between thinking about investing in a corporate and in a sovereign entity. Can you explain a bit, Teal, how principles from ESG have been applied to the sovereign debt space and how this framework fits?
Sure. And I think I'm going to start first with just what's at stake and how well this actually fits, and then go on to actually talk about what exactly are ESG principles and what does that really mean. And to start, just about what's at stake is I got involved with this because I frankly do care quite a bit about sustainability issues. And as a sovereign debt investor, I felt like, getting involved with ESG was a way to, have some sort of positive impact in the role that I was in. I wound up leading Morgan Stanley Investment Management's sovereign ESG research effort. And in the course of that, I found that the way that it was being applied in sovereign debt, which was basically trying to port a framework that had been built for equities over to a very different asset class with very different characteristics, didn't necessarily achieve the goals that people wanted it to. The thing that I found while trying to put together the framework were that the scores that I was seeing really just measured how rich countries were. And that ultimately wound up having fairly perverse effects. It made it incentivized investing all your money in Norway and none of your money in Nigeria, which didn't really fit with what my personal feeling about what the developmental impact of sovereign debt investing could be, which is to actually provide capital to capital constrained countries, in a manner that helps them build infrastructure, helps them, grow the economy. And so, yeah, basically ESG it's a sort of time bound thing. It didn't exist forever. It's really the child in a rebranding of socially responsible investing that happened in the mid 2000s between the United Nations and a bunch of lawyers, and so I think, and it's trying to achieve certain goals. And so I think it's sort of the real question is, how do we do that? I had the chance to then go to the World Bank and to help with research there, looking at these same sort of issues. And so what I wound up doing is really expanding on the research that I've done on Morgan Stanley that was looking at these ESG scores and sort of figuring out, everybody was talking about like, okay, ESG performance and talking about ESG performance, particularly in the context of sovereigns. And it wasn't clear to me that we had a very clear idea of what this actually meant, or whether people were even measuring the same things. And so wound up expanding the analysis, looking at all of the major data providers, doing quantitative analysis on the data, that they were giving us to figure out like what exactly were they measuring? Were they all measuring the same sorts of things? And what exactly is ESG performance? And I think the key findings that we had were that the scores, unlike corporate ESG scores, where there has been a lot of difference between different companies and how they rate different companies, there is actually quite a bit of agreement about how ESG scores wind up rating countries. And that winds up basically having a very high correlation with the country's level of income. The level of correlation between the first principle component of these ESG scores and GNI per capita is 0.9. And that winds up having a fairly significant policy consequences. What it means is that if you're tilting portfolios based upon these scores that are so highly correlated with income, that you ultimately wind up skewing capital flows towards wealthier countries and away from poorer countries. And thinking about the sustainability goals that people are working towards, it winds up exacerbating SDG funding gaps that are already very large, and it winds up incentivizing investment in countries that take more than their fair share of the world's carbon budget, because GDP per capita and carbon emissions are very highly correlated as well.
Can you tell us a bit? You've talked about this correlation between ESG scores and wealth. What do you think ESG investors can do to avoid concentrating their whole portfolios into higher income countries?
Sure. Let me first talk a little bit about what I think the actual goals of ESG investing are, and this is something that was really kind of interesting to dive into. As an investor, I covered 25 countries at a time, and I only had a certain amount of time to devote to actually looking at really doing a deep dive on this. When I went to the World Bank, I got to spend all day every day for a long period of time looking at this, and what I found was there's really two different goals that people have, and I think we have to talk about the goals before we talk about what people could do to achieve those goals. And they are implicit in the marketing material. They're implicit in a lot of the reading, in a lot of the literature. But it's not often talked about in such a direct manner. And it really has to do with, are you looking at ESG as an input into the investment process, where your input is environmental, social, and governance factors, and your output is financial market returns. And that's essentially just expanding the scope of investment analysis. And I think you can look at this almost as as an expansion of what we've seen post global financial crisis, where people want to make sure that investors are actually looking at the known unknowns like climate change, that will actually affect, asset owners' portfolios over the long term. And then the second is about ESG as an output. And this is basically about making the world a better place. And exactly how we define that, winds up being geographically different. It's different to a lot of people. I think simplistically, I usually try to use the shorthand of, does it actually fulfill some of the major internationally agreed upon sustainability goals, being the SDGs, the Sustainable Development Goals, and the Paris Agreement. And I think that's really, that's what we're trying to do. And I think when you say, like, okay, so what can investors do? One is that they can start to look at momentum as opposed to the level. The momentum of these scores, and saying, like, okay, are countries improving or not improving at any given time? And that can be a way that you can align both of these goals slightly better, and in a way that doesn't just judge countries based upon their level of wealth.
And it's interesting. You talked about, particularly on the environmental side, you think about goals of sustainability versus an ESG criterion of resiliency. And, it's very easy to think about countries, take a country, an island country in the South Pacific. They might have really green policies and they're very sustainable, but obviously their vulnerability to climate change is extraordinarily high. So they're not particularly resilient, maybe through no fault of their own. And then you might have, wealthier countries that have much higher resiliency because they're less at risk from climate change, but they're not very sustainable. So, how, as an ESG investor, can you reconcile these two goals of resiliency versus sustainability and not fall into a trap of being overly exposed to climate change if you go purely sustainable and get some countries with low resiliency, or go to the other extreme and focus on resiliency at the expense of sustainability?
Sure. I think this idea between resilience and sustainability is something that I found in reading through the ESG literature and sustainable finance literature was the biggest challenge and sort of one of the biggest misconceptions, is that, like I was talking about in the last question about ESG as an input, ESG as an output, the biggest misconception that I see in the way that this is discussed is that somehow there's some sort of link between pricing ESG risks and making the world a better place. And that ultimately, I think, particularly in sovereign debt, you see that those two things can be very different. And so I think it has to do with two different meanings of sustainability. Resilience is a very valid, use of that word, and looking for portfolios that are resilient to climate change is a very valid thing for investors to want to do. But it doesn't necessarily do the same thing, and it doesn't necessarily make the world more sustainable or make you invest in places that are more sustainable. I like to put some numbers on it. And I think first as an example, when we look at this, is just basically the for sovereign debt, the relationship between cumulative emissions and climate vulnerability is negative 0.9. And so basically what that means is that the countries that have emitted the most carbon, that are most responsible for climate change, also happen to be the ones that are the least affected by it. And so the real challenge is that I think, based on fiduciary duty issues and other things that are genuine binding constraints, the industry and general ESG investing has focused on this ESG integration about trying to price these risks. And in so doing, they ultimately wind up punishing the victims. So I think the TCFD, a lot of these other things, they simply wind up looking at this as a climate risk issue. And I think there's an implicit belief that if you address climate risks in financial markets, that you're going to be doing something positive. That basically, that isn't necessarily the case. And so I think, I think this is partly where there's a question about public policy and like what is the different place for public policy versus investment. I think that there's a real desire, amongst a lot of people to try to punt what are really public policy issues about carbon pricing, about providing climate finance and financing for low-income countries that are climate vulnerable and that have done very little with what the private sector can do. But I think at a minimum, what we can do is to look at the momentum and look at places where there is that sort of overlap.
You touched on fiduciary obligations of investors. And of course, most institutional investors, particularly here in the United States, have this fiduciary obligation to maximize risk-adjusted returns. But as you said, there are some misconceptions within the ESG space, and a lot of these ESG funds are marketed to the underlying investor as being something socially responsible, that they're going to have a positive impact on the environment or other social causes. So behind the scenes, how do these funds actually reconcile those two goals to promote this socially responsible, impactful investment to their clients, but at the same time maintain those fiduciary obligations to maximize risk-adjusted returns?
Sure. I think first to start off is to look at the framing of ESG and its relationship to fiduciary duty, and really going into the weeds of it and going back and sort of reading about all of the history about the formation of ESG. It really has everything to do with dealing with fiduciary duty obligations in a manner that allowed it to become mainstream. People have been investing in ways that were, somehow ethically aligned for centuries. There were religious sects that wanted to make sure that they were not supporting slavery. And then in the 70s, the socially responsible investment movement started to grow, and in the 70s and 80s, about issues like not investing in apartheid South Africa, and other sorts of progressive social issues of that sort. And so really, what the backstory here is an interesting one, and it winds up being a Faustian bargain, essentially, where in order to become mainstream, and to mainstream the analysis of environmental, social, and governance factors, it basically there was a need to not talk about the fact that we're trying to do this to make the world a better place. And essentially, this comes from starting in 1999, Kofi Annan talking to Davos and people in ill-fitting suits, at the height of the globalization era, and talking about how we needed to have globalization with a human face. And the UN then went on to form something called the UN Global Compact, and essentially, amongst other things, wound up working with Freshfields, the law firm in London, to look at how this can be done and what the legal basis for investing with environmental, social, and governance factors was in asset management. And that's really where ESG investing comes from. And the basic takeaway there was something that I think can be best thought of as a decision tree. Obviously, these are multi-jurisdictional legal issues that I'm not a lawyer and not going to pretend to be, but where you see a sort of the business, the business incentive structure here is that essentially what it says is, like, if you're looking at ESG as an input, where your real goal winds up being what's going to maximize risk-adjusted returns, that's allowed everywhere and by all investors. And this is something that had tripped up these SRI funds in the 70s and 80s. That a lot of institutional asset managers couldn't do that because they were prohibited from investing in investment funds that had ulterior motives other than risk-adjusted returns. And so really you see this in a lot of the materials talking about ESG and ESG integration that come from the Principles for Responsible Investment, which is a UN-backed fund that has really been one of the major sponsors of ESG investing. Is that they really only emphasize this, okay, you should do this. If you read the 2019 guidance on sovereign debt, ESG integration and sovereign debt, it only really talks about the fact that this is something that's going to help, maximize your risk-adjusted returns because you're looking at factors that hadn't been considered before. But it doesn't really talk about what it is that you're supposed to do to make the world a better place, or that's even an effort. And sort of that lack of dialogue about what we're supposed to do makes it challenging. So then we come to what exactly can people do? And I think this is a key issue because this is something that is coming under more and more regulatory scrutiny and scrutiny of also, about, from the SEC, from, both regulatory and legal sort of liability issues in terms of mis-selling. People are promising certain things and they're not necessarily able to deliver. And I think there we have to say, like, what is it that we can do in terms of talking about impact? And here there's an interesting literature. There's a very interesting literature review by, I believe it's a paper called Can Sustainable Investing Save the World? And it looks at what are these mechanisms of impact. And they look at three different mechanisms. And again, they're looking at this in the corporate space because most research on sustainable finance is looking at corporates rather than sovereigns. And what they find is that capital allocation, which is really, okay, we're going to put a little bit more money here and a little bit less money here, and that will provide carrots and sticks, that there's a little bit of evidence for that, but not that much. And that's the implicit, mechanism of change that I think ESG investing uses right now. And so that's really an important question: is saying like, okay, here are our goals. Are we actually achieving it that way? Then there's a second aspect of divestment and boycotting and other things like that, and they find no real no real evidence that that works. And I think we're seeing this a lot now with divestments from oil and gas and coal mines and other things like this. All it's been doing is pushing these assets from people who actually care about sustainability issues towards people that don't. And that those people, as long as the private, as long as there is not carbon pricing, and so the private cost and costs and returns from something are not aligned with the social ones, then those are going to still be profitable. And the place where they do find some sort of evidence of impact is an engagement. And this comes to a challenging thing in terms of thinking about sovereign debt. As you said before, corporates are very different than sovereigns, and that ultimately, they're different because when you think about governance, for example, if you think about a company like Vale, we would be talking about what's the structure of the board, and other issues of that sort, corporate governance. Whereas if you're thinking about the country of Brazil, you wind up thinking about things that are much more complicated, like democracy, rule of law, regulatory effectiveness, things of that sort. And then there's this issue about like, okay, what is the appropriate relationship between investors and sovereigns versus if you're a shareholder, you're a part owner of a company, so you have a very good reason to be able to tell them what to do. If you're a sovereign bondholder, there's a much more politically delicate relationship there about what is an appropriate sort of ask. And I think that I've gone down and I've been doing work with the Natural Resource Governance Institute looking at this. And I think that one of the ideas that we have is thinking about transparency, and particularly around natural resource governance. Because here the real issue is like, okay, one, dealing with what are issues that genuinely are financially material to sovereign debt investors. So are things that can be done by investors that do have this fiduciary duty obligations that they have to deal with, and two, that actually have the potential to be positive for countries. And I think essentially the idea is like, look, the more money that goes into actual government accounts from oil and gas, from mining, from other things like that, is both something that benefits investors, because obviously there's more money to pay bondholders, but there's also more money to go to schools. There's more money to go to healthcare, to go to other things that are pushing forward sustainability goals.
So in this conversation, we've talked a bit about the need for ESG investing to conform to the fiduciary obligation of institutional investors in risk-adjusted returns. And you've also touched on this idea that there's this aspiration, especially for clients of these investors, these institutional investors, to feel good about the social impact. In your experience, realistically, how much can we expect from ESG investing in the sovereign debt space in terms of enhancing risk-adjusted returns and also in terms of making the world a better place?
Sure. I think both of those are complicated. And this is where, I try to talk about, I try to look at ESG generally in two different lenses. One is as a policy analyst, thinking about like, what is the role of ESG in terms of actually, what can it do and what can it not do in terms of reaching sustainability goals. And then secondly, as a pragmatist, as somebody who, has sat in the seat of investors and who recognizes that whatever people think about it, there's $25 trillion of assets under management that say that they're trying to use ESG integration in some form. And so how do you do this in the best way that limits potential harm, and hopefully does the best thing? And here, I think that the first thing is I very much agree with Tariq Fancy, who was the former CIO for sustainable finance at BlackRock. He came out in a fairly scathing article and said that, like, look, ESG has the potential to really actually be harming things if it stops people from pushing for real public policy answers to some of these questions. I think in particular about carbon pricing, and I think other people, myself included, I think that have come from an actual financial markets background, understand that, like, look, as long as things that are bad are not, and have negative externalities, as long as those externalities are not priced, then it is in the short and medium term potentially very profitable to invest in them. And the only way that you change that ultimately is by actually pricing externalities and changing it so that you have carbon pricing and other issues like this. And so I think the first aspect is that sustainable finance can only really be a complement to public policy, not a replacement for it. But within that, I think it's about then figuring out, I think the way that I conceptualize it is saying, like, okay, is it a replacement for public policy? Absolutely not. But what it can be is something that's massively scalable, that hopefully can do a little bit of good. And so here, I like to think about this as quantifying what sustainability impact is. And this is always going to be a rough guess as opposed to a science. But you can say, like, what is the scale of the number of dollars invested times the sustainability impact of each dollar invested? And if you think about this with development finance, for example, perhaps the sustainability impact is quite high per dollar invested, but the total envelope of multilateral development banks is about $500 billion, or between 500 and 600 billion dollars. And the size of SDG funding gaps is about $2.6 trillion, according to the IMF. So we have this huge hole there. What's it going to be filled with? I think the more you have some sort of perfectionist, impact fund, other things like that, that has something less than market returns, that's a choice, but it's one that may weigh on how large it can scale. And so where ESG, I think, has some potential is very much on this opposite end, where let's just pretend, for sake of example, that we're talking about 1 cent on the dollar that's going to being, that's going towards sustainable, impact of some nature per year. Then, you multiply that times $25 trillion, that's $250 billion. That's a lot of money. And so I think it's sort of this, what my goal is to try to, poke and poke and poke using data, logic, and other things at things that I think are just offering people a free lunch that isn't able to be delivered, and hopefully, push things towards and trying to then be constructive on what can happen given the binding constraints that we're dealing with, so that we get somewhere closer to that 1 cent per dollar and that $250 billion per year. And that's I think the way that I conceptualize what it can do. Then thinking about risk-adjusted returns and that question, this is one where I think we're really having to move. We've gone from this being a fringe thing to something where massive portions of the assets under management around the world claim to be using this thing. We've already scaled. Now it's time to try to make things slightly more effective and slightly more real, and change things from wishful thinking and marketing towards real research. And there, I think with the risk-adjusted returns, like the question is that it can't just be the marketing slogan of, you're going to make the world a better place and make more money. That essentially a lot of these issues, and I'll focus more on climate at the moment, but we can talk about social and governance issues as well. Um, they're longer term issues and they're forward looking. The challenges about climate change are that, traditionally when you're looking at financial materiality, you would take some sort of time series about financial assets, and you'd take some sort of time series, of some sort of environmental indicators, and you would look for some sort of statistical relationship. That's not going to be the case. One, because the data quality for environmental indicators at a sovereign level, the median lag is 5 years. So you're sort of looking in the rear view mirror in the first place. But secondly, that these issues are going to be worse in the future than they were in the past. I'm from the West Coast, and I now have to plan, trips back to see my family to when fire season is not. That's not something that was there when I was a kid. And we're starting to see extreme weather events and other things like this, being more salient and more real around the world. And so I think there's going to have to be real conversations between asset owners and asset managers about what exactly that looks like. Right now, it's this known unknown. And it's not something that I think shows up in the 1, 3, and 5 year Sharpe ratios. That's not necessarily the appropriate way, but that there has to be a conversation now about how do you actually look at these risks in a forward-looking basis, and how should asset owners, if these are much more long-term risks, how should asset owners be judging asset managers? Because they need to be able to have some sort of way of figuring out if these are 10-year risks, if these are 20-year risks, and those are salient for the asset owners. If you're a pension fund, for example, how do you know whether an investor has great foresight about upcoming risks, or they're just a bad investor, because in the short term they may have very high tracking error, if oil prices go up or oil prices go down.
Finally, briefly, you've talked about how ESG has grown over the last 20 years, and it doesn't at this stage seem like it's a passing fad. I mean, it's something here likely to stay as part of the investment landscape, but there are also limitations. So over the long term, what role do you think ESG criteria and ESG approaches to investing, what role are they going to play in the investment universe?
Sure. I think on a broader level, I think about sustainability issues as being like technology or the internet, in terms of investment and investment booms, and that with both they're can be subject to irrational exuberance, in terms of expectations of what they are and what they're not. And I think similarly to tech, it takes a lot of time for people to find their business models, and we're now, as we record this, seeing another fairly large tech sell-off, and each time, in the 90s, I've said to people, I think right now we're in really a pets.com era of sustainable finance, and it's something where sustainability is something that's here to stay. And it's something that we have to figure out, how to deal with in terms of, in terms of both pricing risks and aligning people's portfolios with sustainability goals. But we should focus on the outputs and the goals, not the specific tools. I think that the specific tools will evolve over time. That there are certain things that are binding constraints that we have to deal with in the short and medium term, that in the medium, longer time horizon we can push out. One of those is about data. The data for sovereign level environmental, social, and governance indicators has huge gaps and lags. I did an analysis of the World Bank's sovereign ESG data portal, and I found that social and governance data had a 3-year median lag, and environmental data had a 5-year median lag. And that's something that we can deal with in the medium term. Some of this is going to come through new technologies for environmental data. There's the potential use of geospatial data to come up with more real time environmental indicators that are actually actionable. And with social and governance is similarly. I think that these things are not panaceas, but there are big data, big data approaches to finding data points that are going to actually be much more real for people. Because I think we've talked mostly about environmental issues so far in the interview, but with social and governance, these are things, first of all, that emerging market debt investors have been looking at forever. They're not new to, they're not new to now. They weren't necessarily called the same thing. But the issue is like, okay, you can look at the worldwide governance indicators for looking at, various aspects of governance of a country. But the real issue is that what matters is this change on the margin. I think about, I think you can think about the Arab Spring, or you can look at Russia and, say that like these issues were latent for a very long time. And what really matters for asset prices and what matters for that sort of pricing these risks and that ESG as an input side is actually being able to identify, change points in a timely manner.
Teal, thank you very much for joining us. It's been a pleasure to talk to you today.
Thank you, Nick. It was a lot of fun.